Bitcoin is surging with renewed vigor in a development that underscores the maturing influence of institutional capital on the cryptocurrency landscape, as fresh waves of inflows into spot Bitcoin exchange-traded funds have propelled prices higher and reignited a sense of bullish conviction across global markets. Welcome to Crypto Hub, your authoritative source for professional analysis and timely insights into the world of digital assets, blockchain innovation, and financial market dynamics, where we cut through the noise to deliver clear, fact-based perspectives that empower informed decision-making. In this detailed update, we unpack the mechanics behind the latest Bitcoin price surge, triggered by substantial ETF inflows, examine the shifting market sentiment that now points toward a bullish reversal, and explore the wider ramifications for investors, institutions, and the broader economy in a manner that prioritizes depth, accuracy, and serious consideration of both opportunities and inherent risks. The events unfolding right now represent more than a fleeting price movement. They signal a potential realignment in how traditional finance interacts with decentralized assets, driven by data that cannot be ignored and trends that have been building steadily over recent months. To fully appreciate the significance of this surge, it is essential to revisit the foundational role that Bitcoin exchange-traded funds have played since their landmark approval by U.S. regulators in early 2024, a milestone that opened the doors for trillions in potential capital from pension funds, endowments, and retail investors seeking exposure without the complexities of direct wallet management or custody challenges. These ETFs, including prominent offerings from firms like BlackRock, Fidelity, and Ark Invest, function as regulated vehicles that track the spot price of Bitcoin directly, holding actual BTC in secure custodians while issuing shares that trade on major stock exchanges just like any other equity. When inflows accelerate, as they have in the period leading up to this latest rally, the authorized participants responsible for creating and redeeming shares must purchase Bitcoin on the open market to back the new shares, creating genuine buying pressure that lifts the underlying asset's price in a self-reinforcing cycle. Recent figures indicate that net inflows into these products have exceeded several $billion over the past 2 weeks alone, a stark contrast to earlier periods of outflows that had weighed on sentiment during phases of macroeconomic uncertainty and profit-taking. This capital injection has coincided with Bitcoin breaking through key resistance levels, moving from consolidation ranges around the mid-$90,000 mark to decisively higher territory, where it now hovers with strong momentum and reduced selling pressure from long-term holders who appear increasingly reluctant to part with their positions at current valuations. The market's turn toward bullish territory is not merely anecdotal, but supported by a confluence of on-chain metrics, technical indicators, and macroeconomic tailwinds that together paint a coherent picture of recovery and accumulation. For instance, the realized price metric, which reflects the average cost basis of all Bitcoin in circulation, shows that a growing portion of the supply is now held by entities with strong conviction, as evidenced by declining exchange balances and rising illiquidity ratios that suggest coins are moving into cold storage rather than active trading venues. At the same time, the Bitcoin network's hash rate continues to achieve all-time highs, demonstrating robust miner participation and network security that further bolsters investor confidence in the asset's long-term viability. Technical analysis reveals a classic breakout pattern on the weekly chart, with Bitcoin successfully reclaiming its 50-day and 200-day moving averages, while the relative strength index climbs out of neutral territory into bullish zones without yet reaching overbought extremes, leaving room for additional upside before any meaningful pullback. Volume profiles confirm that the recent advances have been accompanied by above-average trading activity, particularly in the derivatives markets where open interest has expanded without the kind of speculative frenzy that often precedes sharp corrections. This measured participation from both spot and futures markets distinguishes the current surge from previous hype-driven episodes and lends credibility to the notion that institutional flows are the primary catalyst rather than retail FOMO. Delving deeper into the ETF inflow dynamics, it is worth noting the specific contributions from individual funds that have dominated the leaderboard in recent sessions. BlackRock's iShares Bitcoin Trust has consistently led with daily inflows in the hundreds of millions, reflecting its appeal to large-scale asset allocators who value the firm's established reputation in traditional fixed income and equity products. Fidelity's Wise Origin Bitcoin Fund and Grayscale's Bitcoin Trust, despite earlier redemption pressures, have also recorded positive net creations, indicating a broad-based revival of interest that extends beyond any single provider. These inflows are not occurring in isolation. They mirror a broader rotation into risk assets as central banks signal potential easing cycles, with inflation moderating and employment data remaining resilient enough to avoid recessionary fears. In the United States, the Federal Reserve's communications have been interpreted by market participants as dovish, fostering an environment where Bitcoin's narrative as a non-sovereign store of value gains traction alongside gold and other inflation hedges. Internationally, developments in Europe and Asia have complemented this trend, with certain sovereign wealth funds and corporate treasuries quietly increasing allocations, further amplifying the demand signal transmitted through the ETF ecosystem. What makes this particular surge noteworthy from a historical perspective is its timing within the broader Bitcoin market cycle. Following the 2024 halving event, which reduced the block reward for miners, and historically precedes periods of supply shock and price appreciation, the asset endured a consolidation phase amid regulatory scrutiny and macroeconomic headwinds, including elevated interest rates and geopolitical tensions. The approval of spot ETFs served as a structural shift, yet initial enthusiasm gave way to profit-taking and outflows as some investors rotated into alternative sectors. Now, with those outflows having largely abated and inflows resuming at an accelerated pace, the market appears to be entering a new leg of the bull cycle, one characterized by institutional maturation rather than pure speculation. Comparisons to the 2020-2021 bull run are instructive here. While that period was fueled heavily by retail adoption and stimulus checks, the current phase benefits from deeper liquidity pools, improved regulatory clarity in key jurisdictions, and integration with traditional portfolio construction models, where Bitcoin is increasingly viewed through the lens of modern portfolio theory as a diversifier with asymmetric upside potential. Analysts who track these cycles point to the stock-to-flow model, which continues to project higher equilibrium prices as Bitcoin's scarcity becomes more pronounced with each passing halving, and the current ETF-driven demand surge aligns neatly with those projections by tightening the available liquid supply. Beyond the immediate price action, the bullish turn carries important implications for the wider cryptocurrency ecosystem and traditional financial markets alike. Altcoins, which often follow Bitcoin's lead with a lag, have begun to show signs of life as capital rotates from the flagship asset into higher beta opportunities, though the rotation remains selective and favors projects with strong fundamentals such as Layer 2 scaling solutions and decentralized finance protocols that address real-world use cases. Ethereum, for its part, continues to benefit from its own ETF developments and staking yields, while emerging narratives around artificial intelligence integration and tokenized real-world assets gain traction in an environment of rising risk appetite. For traditional investors, the Bitcoin surge validates the thesis that digital assets can coexist with stocks and bonds, potentially reducing overall portfolio volatility when allocated appropriately through diversified vehicles like the ETFs themselves. Corporate balance sheets are also feeling the influence, with several publicly traded companies announcing or expanding Bitcoin holdings as a treasury reserve asset, citing its superior performance relative to cash during inflationary periods and its potential to enhance shareholder value over the long term. This corporate adoption further entrenches Bitcoin's position as digital gold, a narrative that resonates strongly with the ETF inflows we are witnessing today. Yet in maintaining a professional and balanced perspective, it is critical to acknowledge that no market movement is without risks, and the current bullish sentiment must be weighed against potential headwinds that could temper or even reverse the gains. Volatility remains an inherent feature of Bitcoin, and while ETF participation has introduced stabilizing elements through institutional oversight and compliance requirements, external shocks such as unexpected regulatory tightening, macroeconomic data surprises, or shifts in global liquidity conditions could prompt short-term corrections. For example, if inflation proves stickier than anticipated, prompting central banks to maintain higher rates for longer, risk assets including Bitcoin could face renewed pressure as capital seeks safety in government bonds or defensive equities. Geopolitical developments, ranging from trade tensions to energy policy shifts that affect mining operations, also warrant close monitoring given Bitcoin's dependence on a decentralized but geographically dispersed network of validators and miners. On the regulatory front, ongoing discussions in Washington and Brussels about stablecoin frameworks, anti-money laundering enhancements, and tax treatment of digital assets could introduce uncertainty even as they ultimately aim to foster greater legitimacy and adoption. Investors are therefore advised to approach the current surge with disciplined risk management, considering position sizing, diversification across asset classes, and a long-term horizon that aligns with Bitcoin's historical recovery patterns following drawdowns. From a technical standpoint, the chart setup supports continued optimism provided certain levels hold. Bitcoin has established a higher low relative to recent swing points, with the 100-week moving average acting as dynamic support that has historically proven reliable during cycle transitions. Fibonacci retracement levels drawn from the previous all-time high suggest that the next major resistance cluster lies in the $110,000 to $120,000 range, a zone that, if breached convincingly on strong volume, could open the door to fresh highs not seen since the peak of the prior cycle. Momentum oscillators such as the MACD are showing bullish crossovers on multiple time frames, while the Bollinger Bands are beginning to expand, indicating increased volatility that often accompanies trending moves rather than ranging behavior. On-chain analytics platforms report elevated network activity, with active addresses and transaction counts trending upward in a manner consistent with genuine utility growth rather than speculative froth. The Puel multiple, which measures miner revenue relative to historical norms, sits in a zone that has previously coincided with accumulation phases, reinforcing the view that the market is in a healthy expansion mode supported by fundamentals. Examining the psychological and sentiment dimensions of this development reveals a market that has transitioned from capitulation and despair during the bear phase to renewed hope and optimism, as measured by indices like the crypto fear and greed index moving firmly into greedy territory without yet reaching the euphoric extremes that signal tops. Social media sentiment analysis shows measured enthusiasm among influential voices in the space, with fewer hyperbolic predictions and more focus on sustainable growth drivers such as ETF maturation and institutional custody solutions. Educational content around Bitcoin's monetary properties, including its fixed supply cap of 21 million coins and its resistance to arbitrary inflation through central bank policy, is resonating more strongly with a new generation of investors who have witnessed fiat currency debasement firsthand in recent years. This narrative shift is particularly pronounced among younger demographics entering the workforce and seeking alternatives to traditional retirement vehicles, many of whom view Bitcoin as a hedge against systemic risks in legacy financial systems. Looking ahead, the trajectory for Bitcoin and the broader market will likely hinge on the sustainability of these ETF inflows and the continued integration of digital assets into mainstream finance. Projections from reputable research firms suggest that if inflows maintain their current pace, Bitcoin could see its market capitalization expand significantly within the next 12 to 18 months, potentially eclipsing silver's total value and narrowing the gap with gold as a recognized store of value. Such an outcome would have profound effects on capital allocation decisions across hedge funds, family offices, and even nation-state reserves, where discussions about strategic Bitcoin reserves have gained traction in certain jurisdictions. Technological advancements within the Bitcoin ecosystem, including improvements to the Lightning Network for faster and cheaper transactions, the development of sidechains for enhanced functionality, and innovations like runes and ordinals that expand use cases without compromising the base layer's security, further enhance the asset's long-term appeal. These developments are not lost on ETF issuers, who continue to refine their products and lobby for expanded offerings such as Bitcoin options and futures integration to meet sophisticated investor demands. In parallel, the global regulatory landscape is evolving in ways that could either accelerate or moderate the bullish momentum. Jurisdictions like Singapore, the United Arab Emirates, and Switzerland have positioned themselves as crypto-friendly hubs, attracting business and talent that complement the US-centric ETF narrative. Meanwhile, emerging markets in Latin America and Africa are exploring Bitcoin for remittances, inflation protection, and financial inclusion, creating organic demand that operates independently of Wall Street flows, but ultimately contributes to the same upward price pressure. Central bank digital currencies, while still in pilot stages in many countries, are prompting renewed focus on Bitcoin's decentralized alternative, positioning it as a neutral settlement layer in an increasingly multipolar world economy. For investors navigating this environment, the key lies in separating signal from noise, focusing on verifiable data points such as ETF flow reports released weekly by issuers, on-chain transparency tools that reveal real-time holder behavior, and macroeconomic releases that influence risk appetite across asset classes. As the market digests this latest surge, it is also instructive to consider the role of media coverage and public perception in shaping the narrative. Professional outlets have shifted from skepticism to cautious acknowledgement of Bitcoin's staying power, with coverage increasingly incorporating quantitative analysis rather than anecdotal hype. This maturation of discourse helps legitimize the asset class and encourages broader participation from conservative investors who previously dismissed cryptocurrencies as fringe phenomena. Educational initiatives by industry associations and academic institutions are further bridging the knowledge gap, equipping financial advisors with the tools to incorporate digital assets into client portfolios responsibly. At CryptoHub, we emphasize that while the current environment appears favorable, success in cryptocurrency investing demands rigorous due diligence, continuous learning, and an appreciation for the technology's disruptive potential alongside its speculative elements. The interplay between ETF inflows and price appreciation creates a virtuous cycle that could persist as long as macroeconomic conditions remain supportive and no major black swan events materialize. Miners, bolstered by higher prices and efficient operations, are expanding capacity in renewable energy-rich regions, contributing to both network security and environmental sustainability discussions that have long been a point of contention. Institutional custody providers report record assets under management, underscoring the infrastructure build-out that underpins the entire ecosystem's growth. Derivatives markets are maturing as well, with improved liquidity and options allowing for more sophisticated hedging strategies that reduce the likelihood of cascading liquidations during volatility spikes. All of these factors converge to support the thesis that the market is indeed turning bullish again, not on blind faith, but on tangible evidence of capital commitment and structural evolution. Nevertheless, prudent analysis requires us to model various scenarios, including a base case of continued moderate growth, a bullish case of accelerated adoption leading to new all-time highs within the year, and a bearish case where external pressures trigger a healthy correction that resets valuations for the next leg up. In each scenario, the presence of ETF products serves as a stabilizing force by providing transparent, regulated access that diminishes the influence of unregulated offshore exchanges and reduces counterparty risks that plagued earlier market cycles. For retail participants, the message is clear. Leverage the professional tools now available through ETFs and established platforms while maintaining personal custody options for core holdings to balance convenience with self-sovereignty principles that define the Bitcoin ethos. Portfolio rebalancing should be approached methodically, with allocations calibrated to individual risk tolerance and investment horizons rather than chasing short-term momentum. As we conclude this in-depth examination of the Bitcoin surge following ETF inflows and the market's bullish pivot, the data and trends overwhelmingly suggest a period of constructive growth ahead, provided participants remain vigilant and informed. The developments we have covered today highlight the transformative power of institutional capital when channeled through innovative financial products, reshaping perceptions and realities in the cryptocurrency space. Thank you for tuning in to this professional update from CryptoHub, where our commitment to serious, evidence-based reporting continues to guide investors through the complexities of digital finance. We encourage you to stay engaged with the latest market developments, conduct your own research, and approach opportunities with the discipline that successful long-term investing demands. Until our next report, this is CryptoHub signing off with a reminder that in the world of cryptocurrencies, knowledge remains the most valuable asset of all.